Next question comes from Kurt. We hear so often that investing in large cap funds in the U.S. stock market is like, quote, betting on America. For those of us with federal or military pensions, a large chunk of our future retirement income is already directly tied to the U.S. government's ability to pay in the future, which is arguably dependent on the success of the U.S. stock market. Considering this, should people who will depend on a federal pension invest more in international or other investments, or should we double down on America?
I thought this was a really interesting question because I've actually never considered it or seen it discussed before. I mean, the overall principle of factoring your pension into your overall asset allocation definitely makes sense. And it's similar to what we just talked about in Social Security. So if you were getting your pension, let's say, from a car manufacturer, I would definitely say, like, okay, maybe you would want to hold off on buying too many car stocks. The government is a little different. And previously, we would have all said that, a government pension is pretty darn safe and you don't have to worry about things. Well, then comes the shutdown. And I read on military.com where 50,000 Coast Guard retirees are at risk of not getting their pension check on February 1st due to the shutdown. Now, I think they'll get their check, and if they don't get it on February 1st, it'll eventually come. But I do feel like we're sort of in a new world in terms of where we question things that we kind of always took for granted. So as Kurt brings up the question, I'm like, well, maybe you should. So on the one hand, yeah, maybe you should have, I definitely think every retiree should have some international investments, but maybe you should have a little bit more if you're getting your pension from this big company known as United States of America. The flip side of that is that international stocks are more volatile. Volatility can be very worrisome to retirees because retirees don't often have the time to ride out a bear market and they're forced to sell when things are down. Furthermore, international stocks have an additional risk in that they have currency risk. So even though the stocks themselves might be fine, if the dollar moves in a different direction than the currency of those companies, your purchasing power may come down. So that's sort of standard financial planning advice, is that you have one reason to reduce your international exposure is to reduce your currency risk, because you got to turn your portfolio into dollars that you spend. So I don't have a really good answer for you. It's an intriguing question that I'll have to ponder some more, but I don't think these days it's a bad idea to consider having a little bit more if so much of your retirement is relying on the government.
Bro's going to have to hit the books on that one,
I'm going to have to cogitate on that one a little longer.
Yeah, and I just would offer up a few data points on perspective. I mean, outside of this commentary, which I think is valid, international stocks tend to make up more than 50% of global market capitalization. A lot of other robo-advisors who have smart people coming up with asset allocation guidance for thousands of clients tend to have their portfolios around 40% in international. When I run into clients at Motley Fool Wealth Management, a sister company, the tendency for foolish investors is that they are severely underweight international stocks. That's partly our fault. We don't have an international service, really, to speak of. But just something to think about, in that most people are underweight international stocks. And to be perfectly candid, those people have been rewarded over the last 8 to 10 years because international stocks have not done well over the last 8 to 10 years. And it's a little bit of a confounding factor, but just some stuff to think about as you weigh this quandary.